Good evening, friends. This is the second episode of the educative series released to explain the core concepts used in the financial market. The how and why of various processes used in the financial market will be explained in the series. The series is expected to provide the basics to a lay investor to understand the financial market. The video will run you through the IPO process from the time the application form hits the stands till the eventual allotment and trading of these shares. Generally, an investor would like to have a lot of queries on IPO or primary market, like what is an IPO, why is an IPO required, who can apply for an IPO, when will the money be required to pay for an IPO, when will I get the shares from an IPO, when will I get a allotment of shares if I apply for an IPO, where do I get the IPO application forms from, is it available anywhere in India or outside of India, how is allotment of shares done and how quickly, and many more such queries. Towards the end of the presentation, you will be able to understand the basics of this IPO. Before we go into the nuances of the process, handling of the queries, etc., we will take a look at the credentials of the speaker, disclaimer, and thereafter follow it up with the subject matter. A brief introduction of the speaker would be in order for one to get more confidence in the information or data so provided in the video. I, Ramkumar Krishnan, am a veteran in the industry, having put in more than 30 years of service. I headed business development and new projects in one of the marquee institutions operating in the capital market. Anything one says which involves money directly or indirectly is generally accompanied by a disclaimer. I am currently not registered with SEBI as an investment advisor or as a research analyst. This is an educational video, the view to educate the uninitiated. The situation described in or alluded to in the course of the presentation is based on the extant rules and regulations prevalent in India. Should you find this video informative and educative, kindly pass it on to your family and friends, and also press the join button and subscribe to this channel. You will typically find updates being put on the channel late evening every Sunday and Wednesday. The last screen will indicate the subject matter of the next video. Now we'll talk about the topic at hand. What is an IPO? Generally, when one talks about an IPO, when you will apply for an IPO, etc., they also speak about company being listed and the company going public. But is it the same or does it mean different in different contexts? So we will look at it as we go along. IPO would mean an initial public offer. FPO means further on public offer. OFS means offer for sale. A company uses one or more of the above methods to become a listed company. The issue is typically collectively called an IPO or going public, often used interchangeably. In the case of an IPO, shares are issued by the company in the stock market for the first time. In the case of FPO, new shares are issued by an existing listed company. In the case of OFS, existing shareholders of any unlisted company offer their shares to the new investors. In the case of an IPO or FPO, the paid up capital of the company increases, whereas in the case of OFS, the paid up capital does not change. An IPO is generally the first foray of an unlisted company into the listed space. This is generally used when a said company says it wants to go public. The company would typically be listed in BSE and NSE. The listing itself is either on the main board or the SME segment. One of the exchanges is identified as a designated stock exchange. We will now talk about the IPO allotment rules. The IPO can either be a fixed price IPO or a book building IPO. In the case of fixed price IPO, the company fixes only one price which is taken up as the offer price for the IPO. In the case of book building, the company fixes two prices called the floor price or lower cutoff price and the upper cutoff price. The IPO is made available for the general public for a minimum of 3 days. Anchor investors, if any, are generally asked to bid on the day prior to the IPO start date. The allotment of shares is typically made on or before T plus 2 days, and the listing and trading is on T plus 3 day, where T is the IPO close date. Typically, multiple applications are not allowed in an IPO unless explicitly stated by the company in the prospectus. We will now discuss about the various factors that come about at the time of allotment of shares post IPO. The IPO is generally for a predefined number of shares. The three distinct possibilities on an IPO application is undersubscription, subscription or oversubscription. In the case of undersubscription, the number of shares sought by the investors is less than the shares in offer. However, if the number of shares sought is less than 90% of the shares offered, the issue gets devolved or cancelled. If the shares subscribed is exactly same as the shares in offer, it is fully subscribed issue. If the shares sought is more than the number of shares in offer, the issue is oversubscribed. If the issue is undersubscribed or subscribed, all the applicant investors are allotted shares sought by each of them. If, however, there is an oversubscription, a complicated algorithm is used by the RTA, that is Register and Transfer Agent, to allocate shares and identify the investors who would get the allotment. An IPO typically issues shares come under different buckets as detailed below. RIs, that is resident individuals, these are people or individuals who apply for less than rupees 2 lakh per IPO. NIIs, that is non-institutional investors, these are people or institutions which apply for companies or firms which apply for an amount more than 2 lakh rupees. QIBs are qualified institutional buyers. These people generally would be having rights to apply for up to 50% of the IPO in question. Then there comes the anchor investors who actually will be applying for about 60% of the stock offered to the QIBs. This will be one day before the IPO start date. Second last category is the employees. So employees of the company generally are given option to apply for the IPO. Then existing shareholders, in case a company comes out with an IPO and the existing shareholders of the parent company are given the rights to apply under this bucket of existing shareholders. What is the process followed by the RTA in getting the allotment done? At the first stage, all the applications are collected in terms of number of shares applied for, amount blocked, etc. from BSE and NSE IPO platform, where the investor through the broker updates the data. The RTA thereafter verifies the data of the PAN vis-a-vis BOID with the concerned depository where the demat accounts are being held. If there are any applications where the BOID and PAN with the depository is not as in the application form or are multiple applications, such applications are rejected. The ability to apply for IPO is closed at 1700 hours or 5 p.m. of the last day of the IPO. The data which is typically verified is collected for finalizing the allotment. If there is an oversubscription, as mentioned above, the RTA uses an algorithm to identify the successful allottees and the shares are allotted to each such successful allottee. Around this time, the RTA also instructs the bankers to either release the IPO allotment money in part or full to the designated account of the company, the bank account of the company, or unlock the money in the investor's bank account. The RTA also files the basis of allotment file with a designated stock exchange. On receiving the approval from the stock exchange, the shares are allotted to the concerned demat accounts held by the allottees in the depositories. Simultaneously, intimation on allotment, refund, etc. is shared with the concerned investors. The information is also updated on the websites of the RTAs and exchanges. The allotment is typically done on the second day of the IPO close date, and the listing and trading is done on the third day of the IPO closing date. The following factors need to be considered before one were to invest in a company through IPO route or primary market. The red ink prospectus should be looked at for risks which are red flag risks. Such risk factors are generally made available in the prospectus along with other usual risks like business, competition, regulatory, governmental policy, price, etc. Look at the application bid in the afternoon of the IPO close date. Look at the subscription rate. Take a decision based on the subscription rate. Thereafter, make the application IPO application. Please ensure that you make the application before the cutoff time. This cutoff time would be earlier than the cutoff time declared by the stock exchanges and would change or be different from broker to broker, system to system. Ensure you have required funds in your bank account and approve UPI well before the cutoff time to ensure you get the application accepted. Ensure that the first named holder in the bank is same as that of the first holder in the demat account. We trust you have understood the basics of the working of an IPO. Should you need to know the nuances of the algorithm used for allotment, etc., kindly reach out to me. Should you have any doubts, queries or suggestions, kindly reach out to ramkbharosay@gmail.com. Thanks.